Here we can learn some finances about credit and debit. What are their real meaning and their usage in finance? Welcome back. Debits and credits definition. What are debits and credits? Business transactions are events that have a monetary impact on the financial statements of an organization. When accounting for these transactions, we record numbers in two accounts, where the debit column is on the left and the credit column is on the right. Debits. A debit is an accounting entry that either increases an asset or expense account, or decreases a liability or equity account. It is positioned to the left in an accounting entry. Credits. A credit is an accounting entry that either increases a liability or equity account, or decreases an asset or expense account. It is positioned to the right in an accounting entry. Debit and credit usage. Whenever an accounting transaction is created, at least two accounts are always impacted, with a debit entry being recorded against one account and a credit entry being recorded against the other account. There is no upper limit to the number of accounts involved in a transaction, but the minimum is no less than two accounts. The totals of the debits and credits for any transaction must always equal each other, so that an accounting transaction is always said to be in balance. If a transaction were not in balance, then it would not be possible to create financial statements. Thus, the use of debits and credits in a two-column transaction recording format is the most essential of all controls over accounting accuracy. There can be considerable confusion about the inherent meaning of a debit or a credit. For example, if you debit a cash account, then this means that the amount of cash on hand increases. However, if you debit an accounts payable account, this means that the amount of accounts payable liability decreases. These differences arise because debits and credits have different impacts across several broad types of accounts, which are asset accounts. A debit increases the balance and a credit decreases the balance. Liability accounts. A debit decreases the balance and a credit increases the balance. Equity accounts. A debit decreases the balance and a credit increases the balance. The reason for this seeming reversal of the use of debits and credits is caused by the underlying accounting equation upon which the entire structure of accounting transactions are built, which is assets equals liabilities plus equity. Thus, in a sense, you can only have assets if you have paid for them with liabilities or equity, so you must have one in order to have the other. Consequently, if you create a transaction with a debit and a credit, you are usually increasing an asset while also increasing a liability or equity account, or vice versa. There are some exceptions, such as increasing one asset account while decreasing another asset account. If you are more concerned with accounts that appear on the income statement, then these additional rules apply. Revenue accounts. A debit decreases the balance and a credit increases the balance. Expense accounts. A debit increases the balance and a credit decreases the balance. Gain accounts. A debit decreases the balance and a credit increases the balance. Loss accounts. A debit increases the balance and a credit decreases the balance. If you are really confused by these issues, then just remember that debits always go in the left column, and credits always go in the right column. There are no exceptions. Debit and credit rules. The rules governing the use of debits and credits are noted below. Changes to debit balances. All accounts that normally contain a debit balance will increase in amount when a debit, left column, is added to them, and reduced when a credit, right column, is added to them. The types of accounts to which this rule applies are expenses, assets, and dividends. Changes to credit balances. All accounts that normally contain a credit balance will increase in amount when a credit, right column, is added to them, and reduced when a debit, left column, is added to them. The types of accounts to which this rule applies are liabilities, revenues, and equity. Totals must match. The total amount of debits must equal the total amount of credits in a transaction. Otherwise, an accounting transaction is said to be unbalanced, and will not be accepted by the accounting software. Debits and credits in common accounting transactions. The following bullet points note the use of debits and credits in the more common business transactions. Sale for cash, debit the cash account, credit the revenue account. Sale on credit, debit the accounts receivable account, credit the revenue account. Receive cash in payment of an account receivable, debit the cash account, credit the accounts receivable account. Purchase supplies from supplier for cash, debit the supplies expense account, credit the cash account. Purchase supplies from supplier on credit, debit the supplies expense account, credit the accounts payable account. Purchase inventory from supplier for cash, debit the inventory account, credit the cash account. Purchase inventory from supplier on credit, debit the inventory account, credit the accounts payable account. Pay employees, debit the wages expense and payroll tax accounts, credit the cash account. Take out a loan, debit cash account, credit loans payable account. Repay a loan, debit loans payable account, credit cash account. Debits and credits explained. In double entry accounting, every transaction is recorded with a debit and credit in two or more accounts, which categorize different types of financial activities in a company's general ledger. Debits and credits are both opposite and equal, though each line debit/credit doesn't necessarily have an equal counterpart, occur simultaneously and represent a transfer of value. For example, if a business purchases a new computer for $1,200 on credit, it would record $1,200 as a debit in its account for equipment, an asset, and $1,200 as a credit in its accounts payable account, a liability. If, instead, it pays for the computer with cash at the time of purchase, it would debit and credit two types of asset accounts, debit for equipment and credit for cash. Drilling down, debits increase asset, loss, and expense accounts, while credits decrease them. Conversely, credits increase liability, equity, gains, and revenue accounts, while debits decrease them. As such, accounts are said to have a natural positive credit/debit balance, credit or debit balance based on which one increases the account. For example, assets have a natural debit balance because that type of account increases with a debit. Debits and credits are the foundation of double entry accounting. They indicate an amount of value that is moving into and out of a company's general ledger accounts. For every transaction, there must be at least one debit and credit that equal each other. When that occurs, a company's books are said to be in balance. Only then can a company go on to create its accurate income statement, balance sheet, and other financial documents. What are debits, DR, and credits, CR? In accounting, the definitions of debit and credit may seem counterintuitive to what they mean in everyday language. These differences are important to grasp from the start. In accounting, a debit, DR, typically records an amount of value flowing into an asset or bank account, unlike, for example, a debit card, where money is taken out of an account. On the flip side, a credit, CR, generally records an amount of value flowing out of an asset account, as opposed to receiving credit in the form of a loan or return, where money flows into an account. Debits and credits are recorded as monetary units, but they're not always cash and may include gains, losses, and depreciation. For this reason, we refer to them as value. Debits and credits underpin a bookkeeping system called double entry accounting, in which every transaction equally affects two or more separate general ledger accounts, such as assets and liabilities. Debits versus credits. Debits and credits are like the yin and yang of accounting, interconnected and responsible for keeping a business's bookkeeping entries in balance and harmony. There is no debit without a credit. A debit increases the balance of an asset, expense, or loss account and decreases the balance of a liability, equity, revenue or gain account. Debits are recorded on the left side of an accounting journal entry. A credit increases the balance of a liability, equity, gain, or revenue account and decreases the balance of an asset, loss or expense account. Credits are recorded on the right side of a journal entry. Key takeaways. Every transaction in double entry accounting is recorded with at least one debit and credit. Debits and credits indicate where value is flowing into and out of a business. They must be equal to keep a company's books in balance. Debits increase the value of asset, expense, and loss accounts. Credits increase the value of liability, equity, revenue, and gain accounts. Debit and credit balances are used to prepare a company's income statement, balance sheet, and other financial documents. Why are debits and credits important? Debits and credits keep a company's books in balance. They are recorded in pairs for every transaction, so a debit to one financial account requires a credit or sum of credit of equal value to other financial accounts. This process lies at the heart of double-entry accounting. Accuracy is crucial because accounts roll up into specific lines on a company's balance sheet or income statement, both of which paint a picture of a company's financial health, value, and profitability. They also inform decision-making for internal and external stakeholders, including company management, lenders, investors, and tax agencies. How are debits and credits used? Debits and credits indicate value flowing into and out of a business. They are equal but opposite and work hand in hand. For every transaction, an accountant or bookkeeper places a debit in one account and a credit in another account. No matter how many accounts or line items are involved, the total value of debits equals the total value of credits. How debits and credits affect different types of accounts. An organization's general ledger is composed of 7 types of accounts, which appear on its various financial statements: assets, liabilities, equity, revenue, expenses, gains, and losses. An asset account reflects the value of resources owned by a company and is expected to provide future economic benefit. Examples include cash, accounts receivable, inventory, and property. An expense account reflects the costs a company incurs for conducting business and generating revenue. Examples include the cost of goods sold, COGS, or services delivered, employee salaries, travel, advertising, and rent. A liability account reflects the amount a company owes. Examples include credit card accounts/balances, accounts payable, notes payable, taxes, and loans. An equity account reflects the shareholders' interests in the company's assets. Examples include stocks, distributions, capital contributed, dividends, and retained earnings. A revenue account reflects the amount of money generated from operating and non-operating activities. Operating examples include sales and consulting services. Non-operating examples include interest and investment income. A gain account reflects an increase in value from activities not related to the core business. Examples include money won from a lawsuit and a gain in value from the sale of an asset or business property. A loss account is the opposite of a gain account, reflecting a decrease in value from non-primary business events. Examples include money paid for the loss of a lawsuit and a loss in value from the sale of an asset or business property. Conclusion. The concepts of debits and credits may be clear to accountants and bookkeepers, but they take some getting used to when you're a business owner who thinks in the everyday terms of credit and debit cards. In the world of double-entry accounting, every transaction impacts 2 or more financial accounts, whereby a debit indicates value flowing in and a credit indicates value flowing out. The 2 sides must be equal to balance a company's books, which are used to prepare financial statements that reflect its health, value, and profitability. What are examples of debits and credits? Say your company buys $10,000 worth of monitors on credit. The purchase translates to a $10,000 increase in equipment, an asset, and a $10,000 increase in accounts payable, a liability, for money owed. At the end of the month, you're ready to pay your bill. The accounts payable account will be debited to remove the liability, and the cash account will be credited to reflect payment. How are accounts affected by debit and credit? Debits increase asset, loss, and expense accounts, credits decrease them. Credits increase liability, equity, gains, and revenue accounts, debits decrease them. What are debits and credits? Debits and credits are considered the building blocks of bookkeeping. A debit may be referred to as a DR. A credit may be referred to as CR. These are the shortcut references. Thank you for your time. For more questions, use the comment section below.